we're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. I mean,
Inflation, this double-edged sword, silently chips away at the purchasing power of hard-earned salaries. But in the same breath, it offers a springboard for the savvy investor, transforming potential loss into multiplied wealth. Remember, in the world of finance, the same storm that sinks one ship can push another to its destination. Now imagine you are in the middle of this financial storm. Where would you anchor your investments? First, it's crucial to understand what inflation actually is. In the simplest terms, inflation is a general increase in prices and a corresponding fall in the purchasing value of money. Picture this: if last year a cup of coffee cost you $2, but this year it's $3, that's inflation at work. But it's not just about paying more for your morning caffeine fix. For investors, it's a measure of how much purchasing power your money retains over time. So, inflation isn't just about higher prices, it's about how much purchasing power your money retains. As the winds of inflation whip up around us, it's essential to understand the hierarchy of investments. Stocks, bonds, real estate and commodities, all these categories behave differently in inflationary times. Let's take stocks, for instance. They can be a suitable refuge, especially those of companies that can pass on costs to customers. Bonds, on the other hand, might not fare as well as their fixed returns lose value with rising prices. Real estate tends to hold up thanks to the tangible value of property and the ability to increase rents. Commodities, particularly those like gold, often shine as investors seek tangible assets. But don't just take my word for it. Reflect on the wisdom of Warren Buffett, the 93-year-old investment guru who has navigated these waters successfully for decades. As Buffett wisely puts it, price is what you pay, value is what you get. Inflation can't erode value. So, what's the treasure map to navigate these tumultuous economic waters? To summarize, understanding the hierarchy of investment categories during inflationary times is the key. The right choices can help turn inflation from a threat into an opportunity. This isn't just a theory, it's a strategy used by the likes of Warren Buffett. By following this path, you too can navigate the stormy seas of inflation and take advantage of the situation. Remember, in the realm of investments, it's not the storm that matters, but how we set our sails.
You know, if we dropped $1 million of cash into every household in the United States today, everybody would feel very good, except the people that invested in things that were denominated in dollars. And, you know, yeah.
Let's delve into this. As an investor, it's crucial to think about your returns in real terms. What does that mean? Well, real returns account for the effects of inflation on your investments. Let's take a simple example. Say you're seeing a 10% return on your investments in a year. Sounds fantastic, doesn't it? But hold on. If inflation is running at 7%, your real return isn't 10% anymore. It's just 3%. That's a significant difference. And this is why cash doesn't do well during inflation. Its return is essentially nothing. It sits at the bottom of the investment hierarchy, losing value as inflation chips away at it. So simply put, if inflation is surpassing your returns, you're losing money without even realizing it. Now let's climb up the investment hierarchy and talk about fixed interest rate bonds. A popular choice among safety-seeking investors, these bonds promise a fixed return over a specified period. But are they truly as safe as they seem? Let's unravel the truth with a little help from Warren Buffett. Imagine you've invested in a 10-year US government bond that yields an annual return of 1.8%. Sounds good, right? But wait, there's a catch. Inflation. If inflation is running at 4%, your bond's real return, when adjusted for inflation, actually dips into negative territory to the tune of negative 2.2%. Quite a twist, isn't it? Your safe investment just turned into a loss maker. So while bonds might seem secure, they may not hold up well under inflation's weight. In other words, the perceived safety of fixed interest rate bonds can be somewhat of an illusion in an inflationary environment. Interestingly, not everyone loses during inflation. Let's discuss who wins. When the inflation rate rises, those who stand to gain are individuals or entities that have borrowed money at a fixed rate. Take the instance of a person who has secured a 30-year fixed-rate mortgage at a low interest rate. The beauty of this arrangement is that even in the face of inflation, their mortgage payment remains unchanged. However, the value of the dollar they use to make that payment diminishes. What does this mean? Simply put, they're paying off their debt with dollars that hold lesser value than when they borrowed them. That's like getting a discount on your debt, isn't it? This essentially makes them winners in the inflation scenario, as they're effectively reducing their debt burden without lifting a finger. So in the game of inflation, borrowers with fixed-rate debts can find themselves on the winning side. Let's shift our focus to unproductive assets like gold and silver. They may glitter, but do they truly grow? These shinies often serve as a hedge against inflation, but they don't necessarily increase your purchasing power. Allow me to borrow from the wisdom of Warren Buffett. He paints a vivid picture.
If you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth, at today's market prices, about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, you know, maybe touching it, and fondling it occasionally, you know, and then saying, you know, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that. Add $1 trillion of walking around money. You know, maybe call me crazy, but I'll take the farmland and the Exxon Mobils.
The difference? The farms and companies are productive assets. They can potentially outperform inflation and provide real returns. So while gold can be a safe haven, it's not a growth engine. Remember, it's all about productive assets when it comes to beating inflation. Not all businesses are created equal when it comes to inflation. Let's see why. Average businesses, those that do not have the luxury of a unique product or strong brand, often find themselves in a precarious situation during inflation. Unlike their counterparts with pricing power, these businesses require substantial capital just to keep the gears turning. Imagine a treadmill where you're running faster and faster, but not getting any further. The value of money is eroding due to inflation, but these businesses find themselves investing more and more just to stay in the same place.
Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And you know, the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings. So
it's a bit like chasing your tail. So businesses that require continuous investment to maintain their earnings can be a risky bet during inflation. Now let's talk about a key player in the inflation game, pricing power. In the grand chessboard of economics, pricing power is the queen. It's a crucial asset, particularly during inflationary periods. Picture companies like Apple, possessing a robust brand and a fiercely loyal customer base. They can hike up prices without the fear of losing customers. That's pricing power in action. But let's flip the coin. Consider businesses without pricing power, the ones churning out generic products. Take, for instance, manufacturers of plain white t-shirts. They grapple to increase prices, even when the cost of cotton or labor shoots up. They're stuck in the inflation quicksand, struggling to stay afloat. So, here's the takeaway. When you're evaluating investment options, don't just look at the numbers. Look for businesses that can adapt to inflation. Look for businesses that can flex their pricing power. Therefore, when investing, make sure you're betting on businesses that can adapt to inflation by leveraging their pricing power. Finally, let's discuss the gold standard of investments during inflation. Productive assets. These are the businesses that stand tall even when the economic winds are blowing hard. They are the great businesses with low capital requirements and pricing power. Imagine a hypothetical software company, let's call it John's Software. It's a great business because it can adapt effortlessly to inflation. How does it do that? By being able to increase prices while keeping reinvestment minimal. The software doesn't need new machinery or buildings to increase output, and its loyal customers are willing to pay a little extra for the value it provides. This means John's Software can generate more revenue without significant additional investment. And that's the beauty of great businesses. They can navigate through inflation and still generate real returns for investors. So, remember, great businesses that require minimal reinvestment and have pricing power are the ones that can potentially generate real returns even during inflation.